Senator Bennet.
Thank you, Mr. Chairman, and welcome, Mr. Chairman. Thank you for hanging in there with us today. I'm a little under the weather. One of the great benefits of being at the end of this horseshoe is that you get to hear everybody else's questions and your answers. One of the enormous frustrations to me over the last months and weeks, and I'm sure it's frustrating to you too, is to sit here and listen to senator after senator, myself included, talk about what we're hearing anecdotally on the ground about lending to small business, to hear the stories of small businesses that are maxing out their credit cards because they can't get access to capital at the banks, to hear from community banks that they're unable to lend because they believe the examiners are not giving them the headroom they need to lend. And every time we have this conversation, you answer it wisely and well, which is that you say, we're doing training, we have guidelines, and of course we don't want people to lend poor loans, and no one here wants that either. And I guess my question for you is there a way we can move beyond this conversation to a place where we can actually acquire evidence of whether or not lending is going on in our communities? Is the tightness of the credit related to the fact that we don't have good credit risks, or is it that we're overcautious? I mean, how will you evaluate that? How do you know that your training has worked? How do you know that your guidelines have worked? How do you know what's actually going on in the state of Colorado or the other states that are here? Because what I don't want to do is go through another hearing and another month and another week where we don't know what the evidence really is of what's going on in the ground.
Well, it's intrinsically very difficult to have statistics on how many good loans weren't made, because obviously, if we knew which loans were good, we could just instruct the banks to make them, and it's their credit judgments which are so difficult. What we do, one metric we have.
I might agree with you prospectively, but I mean, even retroactively, if we could look at what has happened, your choice on the period of time, but so that we could take the anecdotal evidence that we have and the efforts that you have made and try to see whether those efforts are successful or not. Because if it hasn't been successful, if people go to the trainings and then come back and don't follow the guidelines that you've given them, or if we are being too conservative, and believe me, I would not stipulate to the view that we shouldn't do bad loans, how are we going to know that or not? And the reason it's so important to me is I don't see any way to get this unemployment rate down without having our small businesses have access to credit. And I think you've heard that universally today.
I've heard it, and I'll give it some more thought. I think one statistic that we have is we do survey the senior loan officers of a large number of banks on a quarterly basis, and we ask them a whole bunch of questions about demand for loans and what they're seeing and so on. And one thing that's been very clear is that the tightness of lending standards imposed by the banks themselves are at record tight levels. So it isn't just the regulators.
So here's what I mean.
Yeah.
First of all, I for one would be very willing to work with you and your staff on this, because we have got to move past this he said, she said aspect of what's going on. You know, you have the regulators or the examiners saying one thing is true. We have an observation like the one you just made about banks holding onto capital, saying that that's the issue. I just feel like we're being guided by sort of vague impressions of what might be going on out there when the people that actually cannot keep their doors open and feel that they are good credit and that they are able to pay can't get access to credit. And they may be wrong. In other words, their credit may not be good, but I can tell you there's an avalanche of that feeling that's out there, and I would like to be in a better position to say, here's what's really going on. Or at least to be able to say, you know, the examiners and the banks and the people in Washington have somehow convened together to try to diagnose the issue so that a month from now we can say things are getting better, or we can say things are getting worse, or we haven't moved off dead center. But we have the frustration is that we have no measuring stick at all, really, other than people's impressions.
other than surveys and data on the kinds of loans being made, the Fed staff did work.
But we wouldn't run our business that way. I mean, it wouldn't be just based on survey data. Survey data is useful, but
I was going to add, I was just going to
I
add that the
apologize.
Fed staff did work with the Treasury trying to develop metrics for the TARP program, and the extent that TARP capital, to what extent did it lead to higher lending? And there was, I think, some progress made there. But your point is very well taken. I've heard this many times, as you can imagine, and I will take this back to our staff and see if we can figure out some more useful metrics or ways of thinking about this problem.
I think, again, it's because of the consequence of my sitting here at the end that I can hear the same conversation over and over and over again. Other people may not.
As you can imagine, I've heard it many
I
times.
know, and I just think it would be useful to everybody if we were able to agree upon a set of metrics going forward. And again, I'd offer to help. You mentioned something early in your testimony this morning about the importance of withdrawing from this economy in a way that creates jobs. I may be putting language in your, I think I wrote it down, in a manner that promotes job creation is what you said, something like that. Could you talk a little bit about that?
Withdrawing the policy accommodation, you mean?
I just wanted to know what you, no, withdraw your balance sheet from our economy.
Right. So as part of the normalization of monetary policy, right now monetary policy is quite supportive of economic growth. We have near zero interest rates. We have a large balance sheet. We have a number of programs to try to keep down interest rates or to improve functioning in key credit markets. As I was describing to Senator Johans, we'll have to unwind those programs, and we have a set of ways of doing that. But basically, the trade-off is the same one that we usually face when we come out of a recession, which is that at a certain point, we have to begin to scale back the amount of stimulus we're providing for the economy so that we don't overshoot and create inflation or other problems down the road. And that's a judgment call because monetary policy takes some time to work. So all I was saying there was that we're going to have to find sort of the right moment, the right communication, so that we can begin the withdrawal of stimulus or continue. We've already really, in some sense, begun that process by reducing some of the size of our programs, for example. How to withdraw that stimulus in a way that will avoid any side effects like inflation or asset bubbles or any other problem, but at the same time be consistent with a sustainable and increasing expansion. That's the challenge that we always face at this stage.
Okay. Thank you, Mr. Chairman. Appreciate it as always.
Senator Bennet, thank you very, very much.